Part 1. The Philosophy of Intelligent Investing. When most people think about investing, they imagine something fast, exciting, and dramatic. Screens flashing, prices jumping, decisions made in seconds. The modern world has trained us to believe that money is made by speed, boldness, and prediction. Benjamin Graham begins from the opposite direction. This book is not about excitement. It's about survival, discipline, and thinking clearly when others are emotional. It's not written for people who want to feel smart. It's written for people who want to stay solvent, grow steadily, and avoid the permanent loss of capital. At its core, the intelligent investor is not really about investing at all. It is about behavior. Graham makes one thing clear early on. Investing success does not come from having superior intelligence, advanced mathematics, or secret information. It comes from having the right temperament, the ability to remain patient when others are greedy, and calm when others are fearful. An intelligent investor is not someone who predicts the future accurately. An intelligent investor is someone who structures their decisions so that they don't need to predict the future. That distinction changes everything. Investing versus speculation. One of the most important foundations Graham lays is the difference between investing and speculation. Most people believe they are investing when, in reality, they are speculating. Speculation is driven by price movement. Investing is driven by value. Speculation asks, what will this stock do next? Investing asks, what is this business worth, and am I paying a sensible price for it? The problem is not that speculation exists. The problem is that people speculate without realizing they are doing it. They tell themselves a story of logic and analysis, but their decisions are guided by excitement, fear, and crowd behavior. Graham does not condemn speculation outright. He simply insists that if you speculate, you must know you are speculating, and you must never confuse it with investing. An investment, by Graham's definition, is an operation that offers safety of principal and a reasonable expectation of return. Anything that does not meet those criteria is speculation. That definition alone forces a radical shift in mindset. It means that risk is not defined by volatility or price swings. Risk is defined by the chance of permanent loss. A stock that fluctuates wildly but represents a strong, conservatively financed business bought at a sensible price may be far less risky than a calm-looking stock bought at an absurd valuation. The defensive and the enterprising investor. Graham recognizes that not all investors are the same. Not everyone has the time, interest, or emotional discipline to analyze businesses deeply. So instead of dividing investors into smart and dumb, he divides them into defensive and enterprising. The defensive investor seeks simplicity, safety, and freedom from worry. Their goal is not to outperform the market, but to achieve satisfactory results with minimal effort and minimal mistakes. The enterprising investor is willing to put in significant work, studying financial statements, evaluating business quality, and patiently waiting for opportunities. But Graham is very clear. Being enterprising does not mean being aggressive or reckless. It means being thoughtful and selective. What matters most is not which category you choose, but that you choose intentionally and stay consistent. Most people fail because they drift. They act defensive when markets are calm, and suddenly become enterprising when markets are euphoric. They take on complexity and risk precisely when caution is most needed. Intelligence in investing is not about flexibility of strategy. It is about stability of character. Inflation, safety, and real returns. Graham addresses a concern that quietly erodes wealth over time: inflation. Holding cash feels safe. Numbers don't move. Balances don't fluctuate. But safety is an illusion if purchasing power is steadily declining. A dollar that buys less every year is not truly preserved capital. However, Graham also warns against using inflation as an excuse to take excessive risk. Many investors justify speculative behavior by telling themselves they must beat inflation at all costs. This thinking leads to disaster. The intelligent investor accepts that no investment is perfect. Every choice involves trade-offs. The goal is not maximum return. It is adequate return with controlled risk. Stocks, over long periods, offer protection against inflation because they represent ownership in real businesses that can raise prices and adapt. But that protection only exists if the investor avoids overpaying and avoids emotional decision-making. Inflation is a slow force. Panic is a fast one. Graham fears panic far more. Market fluctuations and emotional discipline. One of Graham's most enduring contributions is his explanation of market behavior, not as a rational machine, but as a psychological system. Prices move not only because of changes in business value, but because of changing moods. Optimism pushes prices above reason. Fear pushes them below. The intelligent investor does not try to outguess these moods. Instead, they prepare for them. Graham introduces the idea that market fluctuations are not enemies, they are opportunities, but only if you are emotionally prepared. When prices fall sharply, the market is offering businesses at discounted prices. When prices rise excessively, the market is offering to buy your holdings at inflated values. The tragedy is that most people do the opposite. They buy when prices are high because confidence feels safe. They sell when prices are low because fear feels urgent. Graham insists that the investor must reverse this instinct. Not emotionally. Emotionally, fear and greed never disappear, but behaviorally. You don't need to feel confident to act rationally. You need rules. Introducing Mr. Market. To make this idea unforgettable, Graham presents one of the most famous metaphors in investing, Mr. Market. Imagine you own a small business with a partner. Every day, this partner offers to either buy your share or sell you his share, but his mood changes daily. Some days he is euphoric and names a very high price. Other days he is depressed and offers a very low price. You are under no obligation to act. You can ignore him completely or take advantage of his emotional swings. Mr. Market is not there to instruct you. He is there to serve you. The mistake investors make is believing Mr. Market's moods reflect reality. They let his optimism seduce them and his pessimism frighten them. The intelligent investor listens politely and then decides independently. The core principle emerging. By this point in the book, Graham has quietly established the foundation for everything that follows. Investing is about value, not prediction. Risk is about permanent loss, not volatility. Behavior matters more than intelligence. Emotional discipline beats market timing. The market exists to serve, not to guide. Everything else in the book, bonds, stocks, diversification, valuation, margins of safety, builds on this philosophical core. Without this mindset, techniques fail. With it, even simple strategies work remarkably well. And this is where Graham begins to shift from philosophy into practical structure, how an intelligent investor actually builds and manages a portfolio over time. Part 2. Building a rational portfolio. Having established the mindset of the intelligent investor, Benjamin Graham now turns toward structure. Philosophy without structure leads to confusion. Structure without philosophy leads to rigidity. The intelligent investor needs both. At this stage, Graham is no longer speaking in abstractions. He is explaining how a real person, with real money and real emotions, should actually construct and maintain a portfolio in a world that is uncertain and constantly changing. The goal is not brilliance, the goal is resilience. The role of bonds in intelligent investing. Bonds rarely excite people. They don't feel modern, innovative, or bold. But Graham places them at the center of intelligent investing for a reason. They introduce stability. Bonds represent a contractual promise. You are not betting on growth or popularity. You are lending money with defined terms. In exchange, you receive predictable income and the return of principal at maturity, assuming the issuer remains solvent. For the defensive investor especially, bonds serve as an emotional anchor. They reduce the temptation to panic during stock market declines and reduce the urge to chase speculative gains during market booms. Graham emphasizes that bonds are not about maximizing returns. They are about reducing the damage of bad periods. Many investors ruin themselves not during good times, but by being forced to sell during bad ones. Bonds help prevent that. However, Graham is careful to note that not all bonds are created equal. Safety matters more than yield. A bond offering unusually high interest is often compensating for higher risk. The intelligent investor resists this temptation. The purpose of bonds is not to impress, it is to protect. Stocks as business ownership. When Graham talks about stocks, he insists on a mental shift. A stock is not a ticker symbol, not a chart, not a story. It is partial ownership of a business. This may sound obvious, but few investors behave as if it is true. If you owned a private business, you would not revalue it every day based on the mood of strangers. You would judge it based on earnings, assets, competitive position, and long-term prospects. Graham argues that public stock ownership should be approached the same way. Price volatility does not equal business volatility. A company's stock can fluctuate wildly while the underlying business remains stable, or even improves. The intelligent investor focuses on what the business produces over time, not what the market says about it today. Proper allocation: stocks versus bonds. One of Graham's most practical contributions is his guidance on asset allocation. Rather than offering precise formulas or predictions, he sets boundaries. He suggests that an investor should always hold both stocks and bonds, adjusting the balance based on temperament and market conditions, but never eliminating either entirely. This approach prevents extreme behavior. It ensures participation in growth while maintaining protection against severe downturns. For the defensive investor, Graham proposes a balanced approach that avoids dramatic shifts. The exact percentages matter less than consistency and discipline. For the enterprising investor, there is room for adjustment, but always within reason. Graham is skeptical of anyone who believes they can perfectly time market cycles. The intelligent investor does not ask, "What will the market do next?" They ask, "How can I stay prepared no matter what happens?" Diversification: protection against ignorance. Diversification is often misunderstood. Many investors treat it as a way to increase returns. Graham treats it as a way to reduce mistakes. No investor, no matter how skilled, can consistently identify the single best opportunity. Diversification acknowledges this limitation. It is an admission of uncertainty, and that admission is a strength. Graham strongly supports diversification across industries, companies, and asset types. But he warns against over-diversification, where an investor holds so many positions that none can meaningfully contribute. Diversification should reduce risk without eliminating responsibility. Each investment should still meet basic standards of quality and value. The intelligent investor diversifies not to avoid thinking, but to survive being wrong. The danger of following the crowd. One of the quiet threats Graham identifies is social pressure. Markets are not only financial systems, they are social systems. People take comfort in agreement. When everyone is buying, buying feels safe. When everyone is selling, selling feels necessary. Graham insists that the intelligent investor must become comfortable being out of sync. Not contrarian for its own sake, but independent. Following the crowd does not feel risky in the moment. The risk reveals itself later, when the crowd reverses direction all at once. The intelligent investor builds a portfolio designed to function even when the crowd is wrong. Rebalancing and long-term maintenance. A portfolio is not a one-time decision. It requires maintenance, but not constant adjustment. Graham advocates for periodic rebalancing. When stocks rise sharply and dominate a portfolio, trimming them restores balance and locks in gains. When stocks fall and become undervalued, adding to them restores balance and positions the investor for recovery. This process forces the investor to do something emotionally uncomfortable. Sell what has gone up and buy what has gone down. Rebalancing is not about predicting. It is about discipline. The intelligent investor uses structure to override impulse. The quiet power of patience. Throughout this section of the book, Graham repeatedly returns to patience, not as a virtue, but as a strategy. Markets reward activity with excitement, not results. Most successful investment decisions involve long periods of inactivity. Waiting is not passive, it is intentional. The intelligent investor understands that time is not the enemy. Emotion is. By building a rational portfolio grounded in balance, diversification, and realistic expectations, the investor creates an environment where patience becomes possible. And this prepares the ground for the most important concept Graham introduces next, the idea that separates cautious investing from intelligent investing. The idea of margin of safety. Part 3. margin of safety, and the art of valuation. By this point, Benjamin Graham has already separated intelligent investing from speculation, established the importance of structure, and shown how a rational portfolio is built. Now he introduces the principle that quietly governs everything else in the book. If there is a single idea that defines Graham's philosophy, this is it: the margin of safety. This concept is simple in wording, but profound in consequence. It is the difference between survival and ruin, between long-term success and short-term luck. What margin of safety really means? A margin of safety exists when the price you pay for an investment is significantly lower than what the underlying business is reasonably worth. Not slightly lower, not approximately equal. Significantly lower. This gap absorbs errors in judgment, unexpected economic downturns, flawed assumptions, and human emotion. It acknowledges that analysis is never perfect and the future is never fully known. Graham insists that intelligent investing is not about being right, it is about being protected when you're wrong. Most investors reverse this logic. They build precise forecasts, assume favorable outcomes, and pay high prices based on confidence. They leave no room for error. The margin of safety does the opposite. It assumes imperfection from the start. Price is what you pay, value is what you receive. One of the most common investor mistakes is confusing price with value. Price is visible, loud, and constantly changing. Value is quiet, complex, and stable. Graham argues that markets frequently misprice securities, not because investors are stupid, but because they are emotional. Fear and optimism distort judgment. The intelligent investor learns to tolerate this disconnect. Instead of being disturbed by price fluctuations, they expect them. Valuation is not an exact science. It is an estimate based on earnings, assets, stability, and long-term prospects. The margin of safety compensates for the fact that valuation can never be precise. You don't need exact accuracy if you insist on a wide enough buffer. Why high growth often means high risk. Graham is skeptical of growth stories, not because growth is bad, but because it is often overestimated and overpaid for. When investors believe a company will grow rapidly, they project that growth far into the future and justify paying extreme prices today. This creates vulnerability. Growth is fragile. Competition, regulation, technological change, and economic cycles interfere. The further into the future growth is projected, the less reliable it becomes. Graham prefers modest, proven performance over exciting promises. A company that grows slowly but consistently and is purchased at a conservative price often produces better long-term results than a glamorous company bought at an optimistic valuation. The intelligent investor resists narratives. They focus on numbers and evidence, earnings, stability, and financial strength. In evaluating a business, Graham emphasizes financial strength and earnings stability. A company that has survived multiple economic cycles, maintained profitability, and avoided excessive debt demonstrates resilience. This resilience matters more than peak performance. Debt magnifies both success and failure. In good times, it boosts returns. In bad times, it destroys equity. The intelligent investor favors companies with conservative balance sheets, not because they are exciting, but because they endure. Earnings should be evaluated over long periods, not short ones. Temporary spikes and declines are less important than consistent ability to generate profit. Stability creates predictability. Predictability reduces risk. The trap of forecasting. Graham repeatedly warns against the illusion of prediction. Economic forecasts, market forecasts, and company projections often appear authoritative, but they are rarely reliable. Experts are not immune to bias or uncertainty. The intelligent investor does not rely on forecasts to justify high prices. Instead, they rely on current facts and conservative assumptions. If an investment only works under perfect conditions, it is not an intelligent investment. The margin of safety allows the investor to proceed without confidence in the future. Emotional errors are the real enemy. Graham understands human psychology deeply. He knows that the biggest threats to investors are not recessions or bear markets, but their own reactions. Fear causes selling at low prices. Greed causes buying at high prices. Overconfidence leads to concentration and excessive risk. The margin of safety protects not just against external events, but against internal mistakes. It creates space between decision and disaster. Enterprising investors and deeper analysis. For the enterprising investor, Graham allows deeper valuation work, but with the same principle at its core. More analysis does not eliminate uncertainty. It simply refines judgment. Even the most careful analysis requires a margin of safety. The enterprising investor seeks neglected, misunderstood, or temporarily distressed businesses, not because they are risky, but because they are mispriced. The work is not about brilliance. It is about patience and discipline. Opportunities do not appear often. When they do, they rarely look attractive emotionally. The quiet discipline of saying no. One of the hardest skills in investing is rejection. Most opportunities should be ignored. Most stocks are fairly priced or overpriced. Most situations do not offer a sufficient margin of safety. The intelligent investor is comfortable doing nothing most of the time. They wait. This waiting is not indecision. It is selectivity. And it is what allows them to act decisively when the rare opportunity appears. Preparing for the later lessons. By the end of this section, Graham has armed the investor with the most powerful protective principle in finance. With a margin of safety, mistakes are survivable. Without it, even correct ideas can lead to loss. This principle now shapes how Graham evaluates specific types of investments, from defensive stock selection to enterprising strategies, from dividend policy to special situations. The foundation is set. Now the book moves into practical application, how these ideas translate into real-world decisions, rules, and safeguards. Part 4. Defensive Investing and Quality Standards. With the margin of safety firmly established, Benjamin Graham now shifts from principle into application. He begins to describe what intelligent investing actually looks like in practice, especially for the defensive investor, the individual who wants reliable results without constant attention, stress, or emotional strain. This section is not about maximizing returns. It is about avoiding serious mistakes. Graham understands that most investors do not fail because they lack intelligence. They fail because they expose themselves to unnecessary risk, complexity, and emotional pressure. Defensive investing is designed to prevent that. The purpose of defensive stock selection. The defensive investor is not attempting to discover hidden gems or outperform professionals. Their objective is far simpler: to participate in the long-term growth of businesses while minimizing the chance of permanent loss. This requires standards. Graham insists that defensive investors should only own companies that meet clear, conservative criteria. These standards act as filters, eliminating businesses that are too fragile, too speculative, or too dependent on favorable conditions. Without standards, the investor is vulnerable to stories, trends, and enthusiasm. With standards, decisions become mechanical, and mechanical decisions protect against emotional errors. Size and stability matter. One of Graham's first requirements is adequate size. Large, established companies possess advantages that smaller companies often lack: diversified operations, access to capital, stronger bargaining power, and resilience during economic downturns. While smaller companies may offer higher growth potential, they also carry higher risk. For the defensive investor, this trade-off is unnecessary. Graham prefers businesses that have already proven their durability across multiple economic cycles. Stability is not glamorous, but it compounds quietly. Financial strength and conservative balance sheets. Graham places heavy emphasis on financial strength. A company should not depend on constant borrowing to survive or grow. Strong current assets, manageable liabilities, and reasonable debt levels create resilience. When recessions arrive, and they always do, financially strong companies can endure without diluting shareholders or risking collapse. The defensive investor avoids businesses that require perfect conditions to succeed. If a company's survival depends on continued growth, low interest rates, or favorable market sentiment, it fails the defensive test. Earnings record and consistency. Graham demands a history of consistent earnings. Not perfection, but reliability. A company that has demonstrated the ability to remain profitable over many years, including difficult periods, earns trust. This requirement filters out businesses whose success depends on temporary trends, speculative demand, or cyclical booms. Consistency reduces uncertainty. Uncertainty increases risk. The defensive investor prioritizes durability over excitement. Dividend history and shareholder treatment. Dividends play an important role in Graham's thinking, especially for defensive investors. A consistent dividend record signals several things: profitability, discipline, and a commitment to shareholders. It also provides tangible returns independent of market price movements. Dividends impose financial discipline on management. They reduce the temptation to pursue reckless expansion or empire building. While Graham does not argue that dividends alone guarantee safety, he sees them as an important supporting factor in intelligent investing. Valuation discipline, even for quality companies. Quality alone is not enough. A strong company purchased at an excessive price can produce poor long-term results. Graham is clear: no business is so good that it cannot be overpaid for. Even the defensive investor must apply valuation discipline. Earnings, assets, and dividends must justify the price paid. This is where many investors fail. They relax standards for companies they admire, convincing themselves that quality eliminates risk. Graham disagrees. Price always matters. Avoiding the illusion of prestige. Graham warns against the psychological comfort investors feel when owning well-known or widely admired companies. Familiarity creates false security. Prestige creates overconfidence. The market often prices popular companies optimistically, leaving little margin of safety. The defensive investor must resist the urge to equate popularity with protection. Intelligence requires independence. Portfolio construction for defensive investors. Graham encourages defensive investors to hold a broad selection of qualifying stocks rather than concentrating in a few favorites. This reduces the impact of individual company mistakes and reinforces the principle that success comes from discipline, not prediction. The defensive portfolio is boring by design. And boring over time is powerful. Common defensive investor mistakes. Even conservative investors make predictable errors. They chase yield during low-interest environments, sacrificing safety for income. They abandon standards during bull markets, justifying higher prices. They panic during downturns, selling precisely when prices are most favorable. Graham's framework exists to prevent these behaviors. Rules replace emotion. Structure replaces impulse. Transition toward the enterprising investor. As this section concludes, Graham begins to draw a line between defensive investing and more active strategies. He does not encourage everyone to become enterprising. In fact, he warns that doing so without the right temperament and effort often leads to worse results. Enterprising investing is not about being smarter, it is about being more disciplined under pressure. And that pressure increases dramatically when moving beyond defensive boundaries. Part 5. Enterprising Investing and Selective Opportunity. After laying out the conservative structure of defensive investing, Benjamin Graham turns his attention to the enterprising investor. This is not a promotion. It is a warning wrapped in permission. Graham does not suggest that enterprising investors are superior. He suggests they are more exposed to mistakes, emotions, and overconfidence. The potential rewards may be higher, but so are the risks. Enterprising investing is not about activity. It is about effort paired with restraint. Who should be enterprising? Graham is clear. Enterprising investing is not for everyone. It requires time, patience, emotional stability, and a willingness to endure long periods of inactivity or underperformance. It also requires the humility to accept that even careful analysis will sometimes be wrong. If an investor is unwilling to read financial statements, study businesses deeply, and wait calmly for opportunities, they should not attempt enterprising strategies. Effort alone does not guarantee success. Effort applied without discipline often leads to disaster. The nature of enterprising opportunities. Enterprising opportunities do not come from discovering popular companies early. They come from neglect, misunderstanding, or temporary distress. These are businesses that the market has priced pessimistically, not because they are doomed, but because sentiment is unfavorable. This pessimism creates opportunity, but only for investors who can separate temporary problems from permanent damage. The enterprising investor must analyze not just what is wrong, but whether what is wrong is survivable. Value investing beyond the obvious. Graham encourages enterprising investors to look beyond surface metrics. A stock may appear cheap because its earnings have declined, its industry is out of favor, or recent events have frightened investors. But cheapness alone is not enough. The intelligent enterprising investor asks deeper questions. Is the business still financially sound? Are assets sufficient to support operations? Has the company survived similar challenges before? Is management acting responsibly? The margin of safety remains essential. A low price is meaningless if the business cannot endure. Special situations and corporate events. Graham discusses opportunities arising from mergers, restructurings, liquidations, and reorganizations. These situations can create mispricings because they are complex and uncomfortable. Many investors avoid complexity. Others are drawn to it recklessly. Graham urges caution. Special situations require detailed analysis and patience. They often involve legal, operational, or financial uncertainty. When approached carefully, they can offer attractive risk-adjusted returns. When approached casually, they can become traps. Complexity does not equal intelligence. The danger of overconfidence. One of the greatest risks for enterprising investors is success itself. Early wins create confidence. Confidence becomes overconfidence. Overconfidence leads to concentration, leverage, and relaxed standards. Graham warns that intelligence does not immunize investors from error. In fact, it can make them more vulnerable if it breeds arrogance. The intelligent investor remains skeptical, especially of their own conclusions. Selectivity over activity. Enterprising investing does not mean constant action. Most market environments offer few genuine opportunities. Acting simply to feel productive is a form of speculation. Graham emphasizes selectivity. A handful of well-chosen investments, made infrequently and with discipline, often outperform frequent trading. Doing nothing is often the correct decision. Risk management is the real skill. The difference between successful and unsuccessful enterprising investors is not insight, it is risk control. Limiting position size, avoiding leverage, maintaining diversification, and insisting on margins of safety all reduce the consequences of error. Enterprising investors must plan for being wrong. Because they will be. Emotional endurance. Active investing tests emotional endurance more than intellect. Undervalued investments may remain undervalued for long periods. The market may move against you before it rewards you. Criticism and doubt are constant companions. Graham stresses that emotional resilience is not optional. Without it, enterprising strategies collapse under pressure. Knowing when to step back. Perhaps the most subtle lesson Graham offers is the importance of self-awareness. An investor may shift between defensive and enterprising roles over time. When life circumstances change, when attention wanes, or when emotional balance is disrupted, returning to defensive simplicity is wise. There is no shame in reducing ambition. Preserving capital is success. Preparing for the final lessons. As Graham concludes this section, he begins to address topics that sit beneath all strategies: market cycles, investor psychology, and the timeless nature of speculation. He reminds the reader that markets evolve technologically, but human behavior remains remarkably consistent, which is why intelligent investing principles never expire. Part 6. Market Cycles, Speculation, and Human Nature. As Benjamin Graham moves deeper into the psychology of markets, his tone becomes less instructional and more reflective. He is no longer just teaching technique, he is explaining why investors keep making the same mistakes, generation after generation. Technology changes, markets evolve, instruments become more complex, but human behavior remains remarkably stable. This is why speculation never disappears, it only changes its costume. The eternal cycle of boom and bust. Graham explains that markets move in cycles driven not by logic, but by emotion. Periods of optimism gradually turn into enthusiasm. Enthusiasm becomes confidence. Confidence becomes excess. Excess becomes fragility. At some point, a trigger, often minor, shifts sentiment. Optimism turns into doubt. Doubt turns into fear. Fear turns into panic. The underlying businesses may not change much at all, but prices swing violently. These cycles are not caused by ignorance. They are caused by human nature. The intelligent investor does not expect to escape cycles. They expect to endure them. Speculation disguised as innovation. Every generation believes it has discovered a new era. New technologies, new financial products, new valuation methods, all are used to justify abandoning caution. Graham observes that speculative manias often begin with genuine innovation. The danger lies in extrapolation. When optimism removes the need for valuation, speculation takes over. Investors stop asking whether a price is reasonable and begin asking how much higher it can go. At that moment, risk is highest, but it feels lowest. The crowd's illusion of safety. One of the most dangerous beliefs in investing is that collective agreement equals safety. When many people believe the same thing, doubt feels unnecessary. Risk feels diluted. But risk does not disappear simply because it is shared. Crowds magnify emotion, they accelerate trends, and when sentiment reverses, crowds rush for the exit simultaneously. The intelligent investor understands that popularity is often the enemy of value. The myth of the expert forecaster. Graham addresses the authority investors place in forecasts, professionals, and institutions. Predictions are comforting. They offer the illusion of certainty in an uncertain world. But forecasts are shaped by incentives, reputations, and emotional bias. Experts are not immune to crowd psychology. Graham does not dismiss expertise. He dismisses confidence in prediction. The intelligent investor respects analysis, but distrusts certainty. How intelligence fails under emotion. Perhaps the most sobering insight Graham offers is that intelligence does not protect against emotional error. In fact, intelligent people are often better at justifying their mistakes. They create narratives. They rationalize risk. They reinterpret warning signs. Emotion does not override intelligence. It recruits it. This is why structure, rules, and humility are essential. Why defensive principles never become obsolete. Graham insists that intelligent investing principles remain relevant regardless of market evolution. Valuation still matters. Financial strength still matters. Margin of safety still matters. Markets may innovate, but reality does not change. Businesses must earn money. Debt must be repaid. Capital can be lost permanently. These truths anchor intelligent investing across time. Emotional preparation over technical skill. Graham quietly emphasizes that the most important investment preparation is emotional, not analytical. The investor must prepare for boredom, doubt, regret, and loneliness. They must learn to act against instinct without needing emotional comfort. This is why few investors succeed, not because the principles are complex, but because they are uncomfortable. Speculation is not evil. Confusion is. Graham does not condemn speculation outright. He condemns unacknowledged speculation. Speculation becomes dangerous when investors believe they are being prudent while acting recklessly. Clarity is protection. If you speculate, know that you are speculating. Limit exposure. Accept risk consciously. If you invest, demand safety and discipline. Transition toward Graham's final guidance. As the book approaches its later sections, Graham becomes increasingly philosophical. He knows that readers will not remember formulas. They will remember ideas. And the central idea he wants to leave behind is simple. Investment success is not about mastering markets. It is about mastering yourself. Part 7. Temperament, Self-Knowledge, and Financial Wisdom. As Benjamin Graham approaches the deeper layers of intelligent investing, his focus shifts almost entirely inward. By now, the tools are clear. The strategies are defined. The rules have been laid out. What remains is the hardest part. The investor themselves. Graham understands that the greatest challenge in investing is not selecting securities, it is managing behavior over decades of uncertainty, temptation, and emotional pressure. Why temperament outweighs intelligence? Graham makes a quiet but radical claim. The average investor, if properly disciplined, can achieve satisfactory results. Superior intelligence offers only a marginal advantage, and sometimes becomes a liability. Emotional control, patience, and humility matter far more than analytical brilliance. The investor who can remain calm during market turmoil has an advantage no algorithm can replicate. The investor who can wait without anxiety possesses a rare strength. Temperament is not about suppressing emotion. It is about acting rationally despite emotion. Knowing yourself as an investor. Self-knowledge is an investment asset. Graham urges investors to be honest about their limitations. How much volatility can you tolerate without panic? How much complexity can you manage without confusion? How much time and attention can you realistically devote? There is no universal ideal strategy. A strategy that looks good on paper but fails emotionally will eventually collapse. Intelligent investing aligns method with personality. The cost of envy and comparison. One of the most corrosive emotional forces in investing is comparison. Seeing others achieve rapid gains creates dissatisfaction. It tempts investors to abandon discipline in pursuit of excitement. Graham warns that envy pushes investors toward speculation, risk, and eventual loss. The intelligent investor measures success not by outperforming others, but by meeting personal goals safely and sustainably. Why simplicity is a strength. Complexity often masquerades as sophistication. Graham observes that many investors add layers of complexity not to improve results, but to feel intelligent. But complexity increases the number of things that can go wrong. Simple strategies, applied consistently, outperform complicated ones that require constant adjustment and emotional precision. Simplicity creates durability. Financial success versus financial wisdom. Graham draws a subtle distinction between making money and becoming wise. Financial success can be temporary, driven by favorable conditions or luck. Financial wisdom endures. Wise investors respect uncertainty. They accept modest returns with safety. They avoid extremes of optimism and pessimism. They understand that money is a tool, not a scorecard. Long-term thinking as emotional protection. Thinking in decades rather than months changes everything. Short-term fluctuations lose their power. Temporary underperformance becomes tolerable. Market noise fades. The intelligent investor builds strategies that function over long periods, knowing that time smooths randomness. Time is not an enemy, it is an ally. Independence without isolation. Graham emphasizes independence of thought, not isolation from reality. The intelligent investor listens, reads, and learns, but decides independently. They do not reject consensus reflexively. They simply refuse to outsource judgment. Independence is not stubbornness, it is responsibility. Investing as a moral practice. In his later reflections, Graham treats investing almost as a moral discipline. It rewards honesty, patience, humility, and restraint. It punishes arrogance, impatience, and excess. This is not accidental. Markets amplify human behavior. Over time, character reveals itself in results. Preparing for the final lessons. As the book approaches its conclusion, Graham does not offer dramatic revelations. He reinforces what has already been said. He knows that repetition, not novelty, creates understanding. The intelligent investor succeeds not by discovering new truths, but by consistently applying old ones. Part 8. Final Reflections and the Timeless Path of Intelligent Investing. As Benjamin Graham closes The Intelligent Investor, he does not attempt to inspire excitement or urgency. There is no call to action, no promise of extraordinary wealth, no dramatic conclusion. Instead, there is calm. Graham understands that intelligent investing is not a moment, it is a lifetime practice. And like any practice worth mastering, it is built through repetition, restraint, and quiet consistency. The investor's true objective. Graham reminds the reader that the purpose of investing is not to beat others, impress anyone, or achieve status. The true objective is simple: to preserve capital, grow it steadily, and avoid ruin. This goal may sound modest, but it is extraordinarily difficult to achieve over long periods. It requires resisting temptation during booms and maintaining confidence during declines. The intelligent investor accepts that extraordinary outcomes are rare and unnecessary. Adequate returns achieved safely are enough. Why most investors fail. Toward the end of the book, Graham reflects on why intelligent investing is so rarely practiced. The principles are not secret, they are widely known, they are logically sound, but they are emotionally inconvenient. They require patience when impatience is rewarded socially. They require caution when boldness is celebrated. They require independence when conformity feels safe. Most investors do not fail because they misunderstand investing. They fail because they abandon discipline under pressure. The market as a test of character. Graham quietly reframes the market not as a battlefield, but as a testing ground. Markets test patience, humility, emotional control, and resilience. They expose overconfidence and reward consistency. Over time, results reveal behavior. The intelligent investor does not attempt to dominate the market. They learn to coexist with it. Living with uncertainty. One of Graham's most enduring insights is that uncertainty cannot be eliminated. No strategy removes risk entirely. No analysis guarantees success. No diversification prevents all loss. What intelligent investing offers is not certainty, it offers preparedness. Preparedness transforms uncertainty from a threat into a manageable condition. The quiet advantage of discipline. Discipline rarely feels rewarding in the moment. It feels slow. It feels boring. It feels lonely. But over time, discipline compounds. Avoiding large losses matters more than achieving large gains. Staying invested matters more than timing perfectly. Emotional stability matters more than intellectual brilliance. This is the quiet advantage most investors underestimate. Carrying these principles forward. Graham does not expect the reader to remember every rule or standard. He hopes they remember a way of thinking. Treat stocks as ownership in businesses. Demand a margin of safety. Respect volatility without fearing it. Separate price from value. Control behavior before seeking returns. These ideas are sufficient. Investing as part of a balanced life. In his closing reflections, Graham subtly reminds the reader that investing is not life's central purpose. Wealth is a means, not an end. The intelligent investor seeks peace of mind, not constant stimulation. Financial security, not perpetual anxiety. Money should support life, not consume it. The final lesson. The final lesson of the intelligent investor is not about markets. It is about wisdom. Wisdom is knowing what you can control and what you cannot. Wisdom is preparing for adversity without fearing it. Wisdom is choosing restraint when excess is tempting. The intelligent investor is not the one who wins the most, but the one who endures. Closing reflection. If you take nothing else from this book, take this. You do not need to be extraordinary to invest intelligently. You do not need perfect foresight. You do not need constant action. You need patience, you need discipline, and you need the humility to protect yourself from your own emotions. That is enough.